The other day, my father was visibly sad with me. I said, "What happened? Did I make a big mistake?" He said, "Yes, of course you did. You suggested this fund XYZ to me. I actually invested in it. In fact, I also recommended this fund to a couple of my friends. Those guys went and saw 3-year CAGR of this fund. They were very impressed and invested in this fund. But in the last 6 months, this fund is all about disappointment. In this video, I tell you what I told him. Watch the full length of this video. Why we are all wrong about 3-year CAGR. In fact, I have written a lengthy article for Live Mint this month about 3-year CAGR being very deceiving. In fact, it hides more than it tells you. You may ask why. It is because any mutual fund goes through a period of underperformance and outperformance if you look at it on an annual basis. All it says is 3-year CAGR is at 19%. But when you actually break it down into annual returns, you will see that in few years it is very down and in few years it is very up, and therefore 3-year CAGR, 5-year CAGR, 10-year CAGR end up looking very good. The CAGR doesn't capture the investor's behavior. Let me give you an example. There is this XYZ fund which has done extremely well. But when you break it down into annual returns, you will see that before giving this huge return, in the last couple of years, it gave terrible performance. But then there was one big year and 3-year CAGR suddenly started looking beautiful. I'll not name the fund, but people are raving about this particular fund. You should be very careful about choosing the mutual fund, and 3-year CAGR is definitely not the right benchmark. Now you may think, what is the right benchmark? How should I choose a mutual fund? While it is a class in itself, I'll just tell you that don't break it down too small or don't look at a lengthy picture. Just try and keep your selection process to 1-year annual performance. Look at that particular mutual fund's year-on-year performance. I'm very sure the mutual fund would have underperformed in few years and extremely outperformed in few years. All you need to see is the underperformance too bad, terrible, or is acceptable? Again, all you need to see on the outperformance is that, is the outperformance significant? Did the fund manager take extreme risk during that point? There are many quantitative factors that can help you to actually quantify the risk he has taken. If you do these two analyses, you will be able to come to a fair conclusion that this particular mutual fund has the ability to beat the benchmark. While 82% of the active funds have already started underperforming index funds, maybe you get a chance to beat the index itself. This is what I told my dad. I said 6 months is too small any which ways for any fund to actually show performance. Plus the market has also been very down. But give it another 6 months. You may start seeing some decent returns and you will have 1-year figure in place. With 1-year figure, you should be able to judge whether the performance is terrible, terrific, or just above average. Just keep yourself very patient and look for annual returns before choosing a mutual fund. If you want to know more about the article that I've written, I will attach that link in my comment. Please go and visit that article on Live Mint. I am very open to feedback. If you have any views or suggestions, please do let me know. Choose the right mutual fund to create immense amount of wealth. Till then, good luck and happy investing.